Hello everyone, this is the last learning objective today. In this learning objective, we explain the difficulties associated with measuring the performance of hedge fund. For a range of reasons, performance evaluation in the context of hedge funds is a bit different from evaluating performance of a typical managed fund. These reasons are liquidity premium, backfill bias, survivorship bias, change in risk profile, and tail events and skewness. As we have already discussed, one of the key differences between hedge fund and other investment vehicles, such as managed fund, is that hedge funds tend to hold more illiquid assets. Therefore, the typical positive alphas that are generated by hedge funds may potentially be interpreted as a liquidity premium. So because when we evaluate performance, we try to evaluate risk-adjusted performance, we might potentially need to adjust for liquidity, given that liquidity is also a risk factor that these hedge funds are exposing themselves to. An example of the relationship between hedge fund performance and liquidity on the slide here. We can see some historic data in terms of average excess returns that are generated by hedge fund, and on the horizontal axis we have liquidity beta of the hedge fund. Liquidity beta is a measure of the degree of exposure to liquidity risk. We can see that if we plot the values of these hedge funds information through time, there is a pretty clear positive relationship between exposure to liquidity risk and return. So this is giving us an indication that hedge funds returns are actually partly explained by liquidity risk, and this is one big reason why it can be difficult in providing an accurate evaluation of the performance of hedge funds on a risk-adjusted basis. Second problem is backfill bias. As we have already discussed, hedge funds do not disclose much information compared with other investment vehicles, and often their disclosures are voluntary. What this means is that hedge fund returns are only be reported to database publishers in the event that they did well. So when you get return history of hedge funds, that might indicate that this is during the period when hedge fund actually performed well. A survivorship bias is that we will only have the performance of those hedge funds that have succeeded and continue to exist well. We won't have any data on those hedge funds that no longer exist, and often they're the funds that were unsuccessful or performed poorly. So backfill bias and survivorship bias will create an upward bias in terms of estimating the performance of aggregate hedge funds compared to other investment vehicles. Finally, hedge funds are designed to be opportunistic. They have quite exotic investment strategies and considerable flexibility to change the profile of their investments across time. In a nutshell, the risk of hedge fund investments are not constant through time. In fact, risk profiles can vary quite dramatically. Now, we know that traditional measures of portfolio evaluation assumes that risk is constant across the period that we evaluate, and those measures can't be used in case of the dramatic risk exposure changes. So the variation in risk that we see across time means that many of the traditional portfolio evaluation techniques, for example, Sharpe ratio, Turner ratio, or so on, are not valid to measure the performance of hedge funds. Last of all, hedge funds tend to invest in assets that have a negatively skewed return distribution. This means that hedge funds will actually be exposed to tail events, and those tail events may not be observable beforehand. So we might not properly include the risk elements in our risk assessments when calculating risk-adjusted returns of hedge funds. Some examples of tail events include those like October 1987 stock market crash and the global financial crisis. Arguably, those events could not be foreseen in advance, and therefore, if you were trying to evaluate the risk-adjusted performance of hedge funds before this event, you would say that they're performing very well because their risk profile looks such that they had a very low level of risk. But that was only because you couldn't observe the probability with this tail event occurring. And when this particular event did occur, for example, stock market crash, it cost many hedge funds out of business. So this is another reason why hedge fund performance is difficult to assess. Taken together, there is a lot of evidence that shows that it's quite difficult to evaluate the performance of hedge funds. It is difficult to know whether hedge funds perform more favorably or less favorably compared to other more conventional type of funds such as mutual funds. That's the end of our discussion on this learning objective. Thank you.